Ashraf Laidi is a currency strategist at CMC Markets, and he joins me now. Ashraf, thanks a lot for joining us. Let's first up just talk a little bit about this rate decision. Nothing much happened in Japan, but we have a yen which is stuck below, or the dollar stuck below 90 yen here. What's it going to take for any yen weakness, if anything at all?
Yeah, we think that basically what the markets are really doing, we were looking at the dollar and the yen as the two primary ways to fund the carry trades. And with the dollar making a rally that is based on improved U.S. data, expectations of withdrawal of Fed liquidity, that really leaves out as the yen as probably the currency to go in and maybe to use as the funding ways to for intermediate gains in equities and in the commodities. That is not going to weaken the yen significantly. It is just going to cap it. It's going to prevent it from really rising. So what we could be seeing, the dollar would be regaining towards 93 in the middle of the next quarter. But we don't expect any further gains above 93 in the dollar yen.
Yeah, but if we do see the dollar gaining against the yen, surely that negates its purpose as a funding currency.
Yeah, well, exactly. Because you have the pendulum of that is really swinging from the dollar to the yen, and we do think that there is going to be further gains in the U.S. dollar, not only because of these improved data and expectations of withdrawal of liquidity, but what we're seeing is this sudden concentration of negative flows and of negative news flow in the Eurozone that is really causing the euro, which used to be the anti-dollar, is now really helping the dollar indirectly. However, a lot of people are talking about, higher interest rates or withdrawal liquidity in the U.S. to help the dollar. Here is what people may not be looking at. The U.S. Central Bank is not going to be withdrawing liquidity in a vacuum. It's not going to be raising interest rates in a vacuum. As it withdraws liquidity, the Australias, the Canadas, the Norways, the ECB would be at a better point to raise interest rates. And when we're going to get to a point towards the end of the second quarter, that would cap any gains in the U.S. dollar.
Yeah, I mean, did it surprise you, the movement to down for the euro of late?
We were not surprised once we broke a key technical level, which was 148. We are going to, we are really in a time period where the market is quite very sensitive to these technical levels. 148, once it broke, and once we had the negative news with Greece and with Spain and with Dubai, and also combined with the window addressing operations, that is the withdrawal of the dollar shorts, that really led to those stops being hit. And we would be surprised if we break below the 142 level, 141.70 level.
Where does this all leave sterling then, Ashraf?
It's funny that you asked that, because sterling, I really think that it's going to probably be one of the biggest losers among the majors next year. The Bank of England is talking about withdrawing liquidity or no more adding to QE. But you've got the Treasury that is trying to turn the screw on public spending. That is two ways of withdrawing oxygen from an economy that has not really yet emerged out of recession, and the uncertainty with the general election, which really going to be very close, is not going to play very well for the sterling or for the market. So we could be looking at a sterling to go towards 150 level, maybe test around as low as 148 towards the second quarter of next year. And as the higher yielding nations will be able to raise interest rates, we could see the sterling getting hit hardest against the Australias, against the Canada, against the Norway, and we could see euro sterling reaching a bottom around 86 level.
Ashraf, great to see you. Have a great weekend.